Roadshow. You're here with Helen Tarrant, and today I'm going to talk about what to do when you have $250,000. Now, last week I talked about what are you going to do when you have $500,000 in terms of a deposit. This week I'm going to talk about $250,000. What are you going to do when you have $250,000 of a deposit? A lot of people go, well, what can you do, right? You can, of course, go regional into residential and buy a house and go, well, it'll go up by 10%. I'm going to make 25K. Ooh, so what, right? It's not going to change your life, right? It's 10%. People brag about it, but that's not the commercial game. Commercial game is exponential cash flow and gains, right? It's not about greed. It's about strategically doing it. And that's what Unicorn's all about. That's what Helen Tarrant's all about. So it's about actually doing it with precision and strategy. So $250,000, you want to grow it. You're in this spot where, and don't ask the question, should I split it? Because if you split it and you buy a $300,000 property, it's not going to go anywhere. We're taking the $250,000 and we're putting it into one property. Now, what does the characteristic of one property needs to look like? You've got two choices. Really, it's choice A or choice B. You're going to make that decision. There is no gray area with this, because if you do it right, it's going to help you grow faster. Now, number one, if you are a busy professional and you just not sure what you're going to do, you want to spend time uplifting or doing anything, you don't have time to understand everything totally, then you need to take that $250,000 and you need to put it in a property that's going to be a neutral hold right now, a neutral hold. You're working, you're supporting it, you don't need to support this property, supporting your lifestyle and everything else. This property needs to be a neutral hold in a strategic location, right? $250,000 will buy your property around $550 to $600K, right? $550 for $600K. Now, what does that mean? That means that you buy it in Melbourne, Brisbane, Gold Coast, Adelaide, you buy ACT. If you're getting to Sydney, well done, but you need to buy 6% to 6.5%. Don't be greedy. Don't go, I need to be 6.5, I need to be this, I need to be that. No time to be greedy. Got to be realistic. $250,000 in this day and age, whether it's a lease stock loan or if you can do 80% LVR, that could be $1 million you're buying. Now, that is strategic hold in an area where it's neutral. The reason for that is this way. And you're looking for a property that historically in this area is being sold on different yield, much cheaper yield than what it is now, right? So what does that mean? That means that you buy a property that traditionally maybe be sold before COVID in an area that might be 3, 4, 5%, and you're buying it at 6%. So you know there's already a gain. So that means you're buying a property maybe at $60,000 for $1 million purchase at 6%, or $30,000 on a $500,000 purchase. Now, those properties, when the market changes, the interest rate goes down, you have a couple of rental increases, all of a sudden will give you an uplift, right? Your $30,000 on a $500,000 purchase, on a 3% increase, it becomes 3%, 30,900 and goes up and up, right? But the yield will drop, and then all of a sudden your 500K is now worth 600K. That's the goal you want to be within an 18 months period when the interest rate changes. That is the number one focus, because that's going to give you the leverage to get to the second one. And whether that's flicking that one, refinancing against that one, whatever it is, that's a secondary decision once you get there to get you to the next one. So that's really important. And that's you sitting back, not doing anything, neutral hold, nothing you need to do for supporting that. Number two option for you is to go regional. Well, you have no choice. You go into regional. And even if you go regional, you have to wait about 3 months to actually find a property that is right. So this is not just, I'm going to sit on the sideline and wait. I'm going to be actively looking the market, participating. I'm going to be in there. When the opportunity comes, I'm going to jump. And that's where it is. You're going to be in regional. You're going to buy a property that has a tenant in it, because you do need a tenant, because you want the cash flow. It's going to be somewhere around the 7% yield. It's going to give you some cash flow straight away, but the cash flow is not important. The cash flow needs to be recycled back into the property so you can create little tweaks over the next 2 years, right? Little tweaks, because you're not going to find a property that is going to have the massive uplift potential unless you're buying it vacant or that is negative, right? And you can take it $250,000, and if you can support it being negative, you obviously do that. But if you don't, find a property that may be giving you 6 to 7% yield, run down, maybe the tenant's on lower rents, maybe you're going in a lower yield, but you can tweak it. Maybe potentially you could add a signboard. Maybe potentially you could put air conditioning. Maybe potentially you could do an extension. Maybe you can put a shipping container at the back. All of these things you could do to the property, right? That you can do to create a little bit more cash flow. Then you're going to get above that margin. You're going to get the cash flow, and you're going to get a slight lift in terms of your growth as well in that property. But that is a cash flow game. You're going to use the cash flow from that to try to help you at the same time as your other properties or as your income to get to the next deposit. Or if you do, and if it's an uplift, you're going to flick it and do the next property deal, right? So it's really, really important for you to know that when you're doing this, you've got the two choices. If you're really busy professional, you want to go to the metro areas, have a set and forget situation. If you are not as busy and you've got some time, you want to look at a property that is going to give you slight uplifts, but not greedy that it's going to happen in 6 months. It's not going to happen in 6 months. 12, 18 months, and the slight tweaks over time is going to bring the cash flow up. You want to bring the cash flow up by 1% over that time. I have your long-sightedness. Recycle that money back in, so the property is used for that. Recycle the money back in, and then utilizing that to create the uplift so you can finance and go again. And that's if you have some time, because you do need the time to be able to do that. Now, when you only have $250,000, you're going to need your own savings. You're going to need the property to give you the combined oomph to move forward again, right? And you have to work really hard and work really smart in this market. And you want to get to a point, and if you can, and take the risk and understand, have someone to mentor you through it and join a community, is to be able to do uplift deals after you get some cash flow basis so that you've got some security. And then when you do uplift deals, you're going to be able to build on top of that 250 much, much faster. So that is really the key. So when you have 250, go get real. You're going to set and forget growth, natural growth over time. You're going to go to regional, and slowly in time, in about 12 to 18 months, increase the cash flow value of that property. That's your two pathways, right? And it depends on how much time you've got. And they're really, both pathways my clients have done, both pathways I've done. So if you want real hands-on experience, hands-on information, hands-on case studies, reach out to us, helen@unicorn.com.au. Link below, get a copy of the book, join one of our challenges at events. Make sure to, don't forget, hit the bell and subscribe so that you get notified when I talk about the next topic. We're going to talk about where you're going to invest when you have $1 million. And I'll see you in the next video. Bye for now.